hoping that this topic was going to be dead, but it's not. We're seeing more bank failures now. It is still very regionally specific. It is still concentrated to one, a very specific sector of the banking system. But again, what's happening? All these banks that are failing, from Silicon Valley Bank to First Republic in the most recent, and now there's a few more that are being threatened, they're all being threatened because of poor risk management. They bought long-term bonds within their investment portfolio. Those bonds can get severely affected by rising rates. So we've been in this rising interest rate environment for well over a year now, and these bond prices fall as rates go up. Now, when you own a bond like that, a 10-year or a 15-year bond, you know that if you're able to hold it for the maturity of that bond, you get what you paid for back as an investor. But if you're not able to hold it and those bond prices are down 40, 50%, and you're forced to sell it, that's a big loss. And that's exactly what's happening to these banks. It's well known. There's a run on the bank. Depositors want their money back. Those bonds are forced sold. Those banks have to sell them to meet their deposit demand, and eventually it's too much and the bank fails. When the bank fails, the FDIC steps in, and beyond that, there's the lending program that the Fed and the Treasury put together to help make those depositors whole. But the reality is the bank failed, and the assets left are then bought by another bank, whether it's JP Morgan Chase or Bank of America or Wells Fargo. That's when they step in and they sort of scoop everything up at severely discounted values. This is not new. This isn't our first banking crisis. I think banks, we don't have to go back very far to see bank failures in history. 08 and 09, there was a bunch of them due to the mortgage crisis, the housing crisis. You had falling housing prices, defaults on mortgages, and very similar situation. Banks were taking big losses on that. Now, the difference is those were all derivative products back in 08 and 09, which meant it was a multiplier on losses. So rather than say a 2% decline, it was more like a 6 to 12 or even larger because of the multiplier effect derivative securities have. That's why if you invest in derivative securities, you better have a very high risk tolerance and have a strong understanding of what you're investing in. So with these banks failing, what's the impact on the market, the economy? What are we seeing? Well, we know the GDP has declined. So the last GDP report came in at 1.1% for the first quarter. Still positive, but it was underwhelming in terms of expectations. Now, what's a recession? A recession is 2 consecutive quarters of a declining GDP, right? So a negative GDP for 2 consecutive quarters. Well, 1.1, even though it didn't hit expectation, is not a decline. It's still a 1.1 positive. It has to be negative. So are we headed that way? Most economists believe a mild recession is probably around the corner. There's a lot of information to support that. But does that mean the stock market's going to fall apart or collapse? The answer is no. No, while there is correlation to stock market performance in economic recession, those correlations are not directly tied. Often the stock market will lead the economy, right? So if the stock market was severely negative 6 months ago, it can be an indicator that the economy will be negative 6 months later, right? So it's a leading indicator. So last year's performance in the market is a leading indicator of potential economic recession, whether mild or severe. Most economists believe that if we go into recession, it will be mild. Why is that? Employment's still quite strong. The consumer's in a very healthy position still. Corporate America's in a healthy position. Earnings, while somewhat declining, are still pretty strong compared to most major bear markets, if you can look back in history. And the other good news is that diversification is working again. Whereas in 2022, it seemed like everything was down and diversification had gone out the window because bond prices had fallen and stock prices had fallen. It seems as though that tide has turned. Now we're seeing bond prices stabilizing. We're seeing yields stabilize at a much healthier level than we've seen in 10 years in the bond because of higher interest rates. On top of that, the stock market has somewhat stabilized this year and is in a growth mode. So we are positive this year on the stock market, which is very different than 2022. All good news for diversified long-term investors. Now, what's the next big thing? Well, as best we can tell, it's going to be the debt ceiling debate. Right now, we are, as a country, we are going to default on our debt at some point this summer if we don't raise this debt ceiling. So we need the administration, we need Congress, we need all the legislators to agree that to raise the debt ceiling debate in order to avoid default. Now, is the market pricing in U.S. government default? No, the market's not pricing that in, because I think most people would believe that while there might be a whole lot of political pandering and bargaining and noise around this, in all likelihood, it would be full-blown catastrophe if they didn't raise the debt ceiling, and therefore it probably won't happen. They will probably raise the debt ceiling. So hopefully that's the case. I think that most people would agree we probably shouldn't default on our debt and create economic catastrophe. So that's the next big thing that we'll have to watch and monitor. It will likely create some stock market volatility, but shouldn't have much long-term effect if that debt ceiling is raised in time that we don't default. So, through a lot of information today: banking crisis, economy, diversified portfolios, the debt ceiling debate. What do you do with this information? Remember, as a long-term investor, there's always something to be worried about. There's never usually a period of time where you go, hey, everything's perfect. And there's always a reason to be worried. That's why investing can have risk, and that's why you get rewarded for that risk long term. So we have to take everything with a historical perspective. We have to remain confident that we'll overcome these challenges like we always have. And at this point, we don't see any reason to believe that we won't in the future. So everybody has a great week, a great weekend. Remember, prepare for Mother's Day. It's coming up soon. I believe it's May 14th. So guys, get your stuff together and take care of those mothers. Have a good one.